Veteran Affairs Loans Explained. The main benefits of VA loans is that you don't have to put any money down on loan amounts up to $2 million as long as you qualify based on your eligibility, residual income, and DTI, which I'll explain here in a moment. You also get lower interest rates compared to FHA and conventional loans. You never have to pay mortgage insurance, and you can use it an unlimited amount of times as long as you have eligibility. Now, your COE, Certificate of Eligibility, is what me as a lender will get you once you finish your loan application, and this is going to tell us whether or not you've used your benefit before. Also, if you have to pay a funding fee, because although you don't have to put any money down, the Department of Veteran Affairs does have a funding fee. You can be exempt from it if you have service-related disabilities. Here are other reasons why you can also be exempt from paying this fee. The VA funding fee will depend on whether or not you've used your benefit in the past, and if you put a down payment, the fee can be less. That's why sometimes, even though you don't have to put money down, some veterans do decide to put a down payment so that their funding fee will be less. Funding fee is based on your loan amount. So say, for example, you're getting a $500,000 house, you put 0% down, and your funding fee is 2.15%. because it's your first time using your benefit. $500,000 times 2.15% is $10,750. This can be paid upfront at closing or rolled into the loan amount. So then your new loan amount would be $510,750. To qualify you, I'll also look at your DTI, debt to income ratio. Preferably, it should be under 41%. And the way that is calculated is, say, for example, you have $4,000 worth of monthly reoccurring debt, and your monthly gross income is $10,000. 4,000 divided by 10,000 is 40%, so you're just below that 41% and you meet the DTI ratio. We can go up to 50%, but what really matters to us is not DTI, it's actually residual income. It's based on your gross monthly income and subtracting all your expenses, and the money left over needs to meet this chart right here, and as long as you meet that, we're good. It's more important than DTI for VA loans. It's the only loan program that looks at residual income. And this chart is also for states in the South. Other states in the Midwest, West, and Northeast have different requirements, so just look at South states to see if this applies to you. We do also look at your credit score to qualify you, and as long as it's at least 500, you can get approved for a home loan. The Department of Veteran Affairs does not have any credit score requirement, but most lenders do, and we really prefer 580 and above. The higher your score, the lower your rate and better pricing we can get you. I also just posted another video explaining FHA and conventional loans. Go see that video if you're not a veteran, because most people are going to get an FHA or conventional loan.